Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here today with Mr. Jim Rickards, author of the national bestsellers Currency Wars, The Making of the Next Global Crisis, and the more recent, The Death of Money, The Coming Collapse of the International Monetary System. He also serves as an advisor to the U.S. Department of Defense and the U.S. intelligence community. Jim, thank you so much for joining me.
Tekoa, great to be with you. Great to see you.
Yeah, it's great to have you here. I'm very excited to be sitting down with you, and I think the timing is exciting. As our viewers know, and as I mentioned, you are the author of The Death of Money here, the book, and in reviewing your work again, I see a lot of news stories coming out in the global financial press and events happening that you seem to have foreshadowed in your work. I'd like to ask, for the person that is joining us for the first time, could you tell us a little bit about your professional background, how you went from working in the legal profession to now being a financial and global economic expert?
Sure, Tekoa. Well, at this point, the resume is kind of a long one, so I won't kind of go through every twist and turn. But before, I am a lawyer by training, but before I went to law school, I got a graduate degree in international economics from the School of Advanced International Studies. Tim Geithner was one of my fellow alumni from SAIS, but SAIS, School of Advanced International Studies, is well known as the intellectual training ground for the IMF. It's a place, it's a school a lot of people go to if you want to work for the IMF. They take a lot of graduates, and a lot of the professors at SAIS are IMF officials who come over, because they're all in Washington, D.C. The IMF is literally right around the corner, just a few blocks from the school, and so a lot of IMF officials come in as adjuncts. So it's an intellectual symbiosis between the School of Advanced International Studies and the IMF, and that is where I went to graduate school in economics. Now, interestingly, my class was the last class to be taught about gold as a monetary asset. I graduated in 1974. A lot of people think the world went off the gold standard in 1971 when Nixon gave his famous speech, but that's not quite correct. If you listen to what Nixon actually said, and interested viewers can find the video on YouTube with no difficulty, but Nixon didn't say we're going off the gold standard. He said, I am temporarily suspending redemptions of dollars for gold. That was the ability of our trading partners to take their dollars and cash it in for gold, but he used the word temporary. And I recently had occasion to speak to Paul Volcker about it, because Paul was one of the people in the room when that happened. There was a small group that went up to Camp David. There was President Nixon, John Connally was Secretary of the Treasury, Arthur Burns, who was Chairman of the Federal Reserve, Paul Volcker, who was Deputy Secretary of the Treasury, and actually another friend of mine, Ken Dam. Ken very kindly offered a jacket blurb on Death of Money, but people who don't know Ken should know that he was up at Camp David that weekend. But Nixon, what Nixon actually said, and Paul Volcker confirmed this when I spoke to him, is that they didn't think they were going off the gold standard. They thought they were calling a timeout. They thought this was a temporary suspension until the major global powers could get together and come up with new, what they call rules of the game, kind of rewrite the system, and that they might get back to a gold standard. Now, it would have been a different price. Clearly, the dollar needed to be devalued, and that's actually what happened. In December, so the Nixon speech was August 71. December 71 was the Smithsonian Agreement, and at that time the dollar was devalued. The price of gold, the official price of gold, was raised to about $42 an ounce from $35 an ounce. So that was a 20% devaluation of the dollar, and we were still on the gold standard at the time, but you still couldn't redeem. So the joke was, the U.S. policy was, instead of not selling you gold at $35, we won't sell it at $42. The U.S. wasn't redeeming either way, but officially the price had gone up. And we kind of bumbled and stumbled our way through the next 3 or 4 years. There were a series of international monetary conferences conducted and studies, working groups under the auspices of the IMF. The world wasn't sure if would they go back to fixed exchange rates, would they move to floating exchange rates? Would you have sort of dirty floats and pegs? Would there be a gold standard? Would there not be a gold standard? That was all unclear until 1975, when the IMF finally broke the link to gold and demonetized gold. Well, my year was 1974, so I actually studied gold when it was still a monetary asset. And interestingly, so I was say a 25-year-old grad student in economics, but my professors were people in their 50s or older who were the young guns in the early 1950s at the origin of the IMF. So I was being taught by people who ran the Bretton Woods system in the 1950s and 1960s as scholars and technical analysts, and they were my professors. So I say anyone who is younger than I am who knows anything about gold is either self-taught or they went to mining college, because they literally stopped teaching it in 1974, 1975. So part of what I try to do in my books is to reintroduce some of that education. But then I went to law school. I started my career at Citibank. I was there for about 10 years. I worked for one of the primary dealers in U.S. government securities. Today it's been bought by larger banks, but it's now part of RBS, Royal Bank of Scotland. But my old firm is now the primary dealer in RBS. Then I worked famously at Long-Term Capital Management, the hedge fund. Did a few other things, worked for Bruce Governor at Caxton, and became an author. And also after 9/11, an advisor on financial threats and financial warfare to the U.S. intelligence community. So a little bit of an eclectic career, but my books are Currency Wars and the Death of Money are a good chance to bring a lot of that perspective and knowledge and learning experience to an older audience who cares about their net worth and a younger audience who actually have not studied a lot of these things. So I think it's amazing how I do have quite a few younger, people in their 20s and 30s. And this all happened before their time, but they can read the books and get some of that flavor.
Jim, the price of gold as of late has been weak. The weakness that we're seeing in the price has been pronounced following an announcement from the People's Bank of China that their exchange reserves are lower than what maybe the investment community was hoping for or expecting. What were your thoughts when you saw that release come out?
Well, a couple things. First of all, I actually explained this and did predict this in my book. The Death of Money came out in 2014, but of course I was writing it in 2013. It was published in 2014. But in the book, I said that the Chinese would likely update their gold reserves in 2015, which is exactly what's happened. Because they're on this sort of 6-year tempo. They did it in 2003, then 6 years of radio silence. They updated it in 2009. 6 more years of radio silence. They updated in 2015. So there's kind of Chinese like precedent. They don't like to break the mold, so to speak. So the 2015 was a fairly straightforward call. I don't know if it'll be another 6 years. The Chinese are trying to play nice with the IMF because they want the yuan, their currency, included in the basket of currencies that's used to determine the value of the world money, which is the special drawing right of the SDR that's printed by the IMF. So China wants to get into that club. Well, it's like joining any club. You have to play by the rules. The club says, wear a suit and tie, you wear a suit and tie. And in this case, the IMF club says, you have to be a little bit more transparent. So China's doing this in an effort to be transparent. But so they may update, from now on, they may update their gold reserves more frequently than this 6-year tempo I just described, as a way of showing the IMF that they're ready to be, fully or at least partially transparent members of the International Monetary System. Having said that, the 604-ton update, they went from 1,054 tons, which was a lie, to 1,658 tons, which was another lie. But they've updated the lie. When I say lie, I mean they're non-transparent, and this is also explained in my book, The Death of Money. They have 3 sovereign wealth funds, or government entities, government portfolios, if you will. One is the People's Bank of China. So that's the one that updated their reserve position and reported the 604 additional tons of gold. But the other one is CIC, China Investment Corporation, which is a sovereign wealth fund. And the third one, which is the most mysterious and biggest of all, is SAFE. SAFE stands for State Administration on Foreign Exchange. And what they do, SAFE actually buys the gold, and then every now and then through a bookkeeping entry, they flip it over to the People's Bank of China, and then the People's Bank of China updates their reserve balances. So I'm not saying the People's Bank of China is lying about their gold. That is how much gold they have, but what it ignores is how much gold does SAFE have off the books. And there, it's reasonable to estimate at least 3,000 tons, maybe more. There's some reason to think it could be more. And how do we know that? I mean, I'm not just guessing. We know mining output. It's about 450 tons a year, has been for a number of years. We know Hong Kong imports. They run between 700 and 1,000 tons a year. So just combine those two sources, let's just say there's about 1,300 tons a year between Hong Kong imports and mining output that we know about. Now, I also know, because I've been in China and spoken to secure logistics people, that some gold is being brought in completely off the books, actually overland, using People's Liberation Army assets, probably coming in from Kazakhstan, maybe Russia. Source is not clear, but there's some additional gold coming in. But let's just take what we know about it without speculating too much. About 1,300 tons of gold. This has been going on for 5 years, so that's 6,500 tons of gold that we know about, not counting what we don't know about. Now, what we don't know is, okay, how much of that gold is going into private hands and how much is going to the government, say for the People's Bank of China? That's unclear. I assume 50-50. Could be wrong. Could be more to the private sector, more to government, but in the absence of better information, that's a good first estimate. So it looks like 6,500 tons plus have come in, and assuming 50% of that is going to the government, then there's over 3,000 tons that the government has added that the People's Bank of China has not reported. They just park it in safe in the meantime. So we can be certain China has a lot more gold. If the price of gold went down because people were expecting it to be a lot more and it turned out to be less, that's not, I mean, the price is what it is. I'm not disputing the price, but that's no reason to mark down the price of gold, because China actually does have a lot more gold than we know it. Now, there may be hedge funds and technical traders. The declining price of gold, by the way, that's if you make the dollar the measure of all value. When people say gold went down, I say, well, no, it didn't. Gold is gold. It's just gold. It just kind of sits there. The dollar price went down. But what is your numeraire? What is your way of measuring it? So when I see, if you say the dollar is the measure of all value, then yes, gold went down. That would be one way to think about it. But if you make gold the measure of value, to me what really happened is the dollar went up. In other words, the low dollar price of gold is really a strong dollar phenomena, more so than a weak gold phenomena. You get more gold for your dollar. But you could say gold went down, but it would be equally valid, equally logical to say, no, the dollar went up. We have a stronger dollar. Well, that's how I view it, and my basis for that is gold's not the only thing that has a lower dollar price by weight. Copper, wheat, corn, steel, lumber, iron ore. Look at commodities around the world. Look at all the other currencies: Australian dollar, Canadian dollar, Japanese yen. Every one of them is down, if you will, against the dollar. To me, what's the common denominator? Well, it's not that the price is down, it's that the dollar is up. We're living in the world of king dollars. But what is that? That's deflation. That's the definition of deflation. When you get more for your money, when the dollar's worth more and goods in dollar terms cost less, that is what deflation is. But think about it from the central bank's point of view, from Janet Yellen's point of view. She wants inflation. She told us that. It's not a secret. She publicly says she wants inflation. We're getting deflation. She's threatening to raise interest rates, which would add more deflation. So how does that work? The answer is it doesn't work. This is why it's been very easy to say, I said last year in 2014 that the Fed would not raise interest rates in 2015. That was when Wall Street was saying March, and then when March came and went, Wall Street said June, and June came and went, and then Wall Street says September, and September is going to come and go, and will be December, but I think we're going to get to 2016, and they still won't be able to raise interest rates because of the power of deflation. So I look at the commodities complex, including gold, and what I see is not that the price is down, although nominally it is. To me, it's just a strong dollar story, but that's non-sustainable because the strong dollar is killing the U.S. economy.
Something that comes to mind, Jim, is a process that you spoke about a little bit in The Death of Money, and that is the channels of passage that the People's Bank, China, needs to use in order to accumulate their gold position, and that the environment is very sensitive to a much larger picture of currency rearrangement in the world. Some folks call it manipulation, and what are your thoughts?
Well, you can call it manipulation, and it is in a way, but it's also policy. Countries are very powerful. Countries have interest rate policies, foreign exchange policies, tax policies, and they have a view on gold. They don't talk about it. And again, you can say it's manipulation, but it's really just the countries implementing their individual policies. Now, China's view of gold is fairly straightforward. They have $4 trillion equivalent in reserves. The vast majority of that is denominated in US dollars. Some of it's gold, some of it's euros, some of it is other things, but the vast majority of it is US dollars. The vast majority of that is in US government securities. So when people say China wants to get rid of the dollar as a global reserve currency, no, it's nonsense. The dollar has no greater friend. China is the dollar's greatest friend. China wants a strong dollar because they own so many of them. If you had $4 trillion, you would want a strong dollar too. The problem is the United States doesn't want a strong dollar. We're getting one right now. Yeah, as I say, I call this Mick Jagger economics, the Rolling Stones song, you can't always get what you want. The central bank, the Fed wants inflation, but can't get it for the time being. They will get it eventually, but it's going to take longer than they thought. But in the meantime, China wants a strong dollar because they own so many, and a weak yuan because that helps their exports. The US wants a weaker dollar to encourage inflation, but we're not getting it, so that's going to tell us something about the future of Fed policy. But China fears that the US will ultimately be successful in getting inflation. They're looking at the Fed. We're not seeing inflation right now. In fact, we're seeing deflation or disinflation, but they believe the Fed will eventually get the inflation they want. So that's going to reduce the value of their dollar assets. If you inflate the dollar by 10%, even 2% a year for 5 years, that's a little over 10% with compounding. Well, a 10% devaluation of the dollar is a $400 billion wealth transfer from China to the United States. If they have $4 trillion and you devalue it by 10%, you're moving $400 billion of wealth from China to the US because the debt we owe them is worth less, and we can pay it off in cheaper dollars. So they're worried about that, and they're vulnerable. People say, oh, they're going to dump US treasuries. No, that's nonsense also. They're not going to do that. They couldn't. First of all, the market's not that big. I mean, the US Treasury market is a deep liquid market, but it's not that deep. It's not that liquid. There's no way China could offload a lot of securities without that immediately coming to the world's notice. If it became malicious, almost a form of financial threat, the president could stop it by executive order. And why would China do that? Because they would be devaluing their number one asset. It's like setting your own house on fire. They wouldn't want to do that. But they can do something else. At the margin, as they acquire additional reserves through exports, through their current account surplus, instead of buying more dollars, they can buy gold. And that's exactly what they're doing. So they've got this big pile of dollars. They're worried about the dollar being devalued. They don't want that. They want the dollar to be strong, but they're afraid that the Fed's going to succeed in getting inflation, devalue the dollar. They can't dump the dollars. They're stuck. They paint themselves into a corner. So what they're doing is acquiring a big pile of gold. So now when you have dollars and gold, you have a hedged position. If the dollar remains strong or gets stronger, the gold's not going to do very much. The gold might go down a little bit, but you don't mind because you got these dollars over here. But if we do get inflation and devalue the dollar, the Chinese are going to lose here, but they're going to gain on the gold because obviously gold will go up in inflation. So the Chinese are not stupid. They're not speculators. What they're doing is they're hedging the dollars. Say, I got a big pile of dollars. I'll have a big pile of gold. One of them's always going to win. If the dollar's going down, gold's going up, as we explained earlier, or maybe if the gold's going down, the dollar's going up. Either way, they win. So they're just building a hedge. But think about it. If the hedge needs to be bigger, they don't have really enough gold, certainly not to fully hedge the dollar position, but even to kind of delta hedge it. So they need to buy more gold. And people, a lot of gold investors and gold bugs say, China's going to bash the dollar and come out with a gold-backed currency and the price of gold is going to go to the moon. Also nonsense. China doesn't want that. As I explained, they want a strong dollar. But if we weaken the dollar, they'll make a lot of money on the gold. But for now, they need to buy more gold. If you needed to buy gold, would you want a high price or a low price? You'd want a low price because you're still buying. The time may come when the US succeeds in getting inflation, the value of the dollars are being inflated away and the value of the gold goes way up. Then at that point, the hedge will work the way the Chinese want it to work. But in the meantime, since they're still acquiring, they want a cheap price of gold. So there are a lot of forces at play in the world. People who think the Chinese are naively trying to destroy the dollar, naively trying to help gold investors. China is out to help China. They're not out to help you, they're not out to help me, they're not out to help gold. They're out to help themselves. But what that means is they have to acquire a lot of physical gold. What's interesting about that is, we all know, there's not that much physical gold around. So I personally like to buy physical gold, and I recommend it to investors. I think when the system breaks down, which I do expect, when the system breaks down and the price of gold begins to skyrocket, people say, oh, I'll go out and get my gold then. Guess what? You might not be able to find it. The time to get your gold is now.
Well, Jim, in your mind, what does that look like when the system begins to break down and gold behaves differently in U.S. dollar term price?
Right. Well, you know, people like to criticize the dollar, and they say it's not backed by anything. And they'll say the same thing about Bitcoin. You know, Bitcoin's another form of money, another currency, and they'll go, well, I don't like Bitcoin because it's not backed by anything. Well, guess what? The dollar and Bitcoin and all other forms of paper money or digital money are backed by one thing, which is confidence. If people think it's money, it's money. If you have confidence in a form of money, then it has value. So right now the dollar and the Bitcoin are backed by confidence, but let's talk about the dollar in particular. The problem with confidence is it's very fragile, it can be lost very quickly, and once you lose it, it's very difficult to regain. And I don't think the Fed understands that. I think the Fed takes the value of the dollar for granted. They assume that confidence will always be there. They assume that they can print as much money as they want, try to get as much inflation as they want, and people won't lose confidence in the dollar. And I think that's analytically and historically incorrect. I would say that for now, yes, confidence is being maintained. But in a complex dynamic system, it's a little bit like running a nuclear reactor. It can run well for a long period of time, but if you push one wrong button, the whole thing melts down catastrophically. You create a chain reaction and it melts down out of control. And it happens very quickly. And the same thing is true of the dollar. Some set of circumstances, maybe something we can foresee, maybe something more likely that we don't foresee. It's often the thing that you don't see coming that gets you, but something could trigger this. And the system is already unstable. It's highly unstable. But it's chugging along. The confidence is being maintained. If it's lost, it can melt down very quickly. And that's where gold, see, I don't see a slow, steady increase of gold up to, you know, $10,000 an ounce. I see it kind of chugging along, you know, down a little, up a little, in a range, but all of a sudden, you know, boom, the day will come, it'll be up $200 an ounce in one day. Boom, next day, $200 an ounce. And then people will be saying it's a bubble, and then boom, the next day, up another 3, 4, like just start to really go hyperbolic. That's when the panic sets in. That's when confidence in paper money is being lost, as reflected in the higher dollar price for gold, just the dollar price being inverse to the value of gold that people assign. At that point, you know, the talking heads on TV will still be saying, you know, it's a no intrinsic value, it's a joke, it's a bubble, et cetera, but it will have a life of its own and the price will go a lot higher. But at that point, you might not be able to get it. You might find that all the weak hands have already got rid of it. The strong hands are holding onto it. Why would you sell in that situation? And you know, you'll call your dealer and they'll say, sorry, I'm out of stock. And you'll call the mint and they say, we're not making deliveries. And you know, big guys, people who deal in tons, you know, may be able to get some of it, but may not. The unallocated gold holders of the LBMA contracts, they're going to call their banks and say, I want to go allocated, I want to take physical delivery. And the banks are going to say, sorry, we don't have it. We're going to send you a check for the price difference and terminate the contract. People are going to find that the paper claims are just paper. So, so my advice is, well, again, what are you waiting for?
Jim, there's one more question I want to ask you, and then there's a passage in your book that you mentioned would be of interest. What have you found to be the risk and the importance of telling the truth when we look at the political stage globally? Throughout the circles that you travel in and the things that you've seen, what are your thoughts there?
Well, I guess I would start by saying truth has sort of a ring of absolute, you know, moral and scientific certainty to it. So I want to, I do the best I can. I work hard. I do the analysis. I read a lot. I travel a lot. I talk to a lot of people. I give people the best analysis I can, and I believe in it. I wouldn't put anything out or publish anything or say anything that I didn't personally believe in. So it's the truth as far as I know, but I don't want to claim moral certitude, but I do the best I can in terms of my analysis. What I find, and I've spoken to members of the Board of Governors of the Fed, I've spoken to Regional Reserve Bank presidents, I've spoken to senior officials of the IMF, I've spoken to heads of state, I've spoken to Nobel Prize winning economists. I am privileged in the sense of being able to meet a lot of those people. I spoke to Ben Bernanke recently in Korea, one-on-one. We were in a small group of about 10 of us and had a nice conversation with the former chairman then. And I find that sometimes they will say things privately that they won't say publicly. Part of that is just institutional constraints. If for a chairman to say something pretty candid about gold, it could start a panic, and they're very aware of their institutional responsibilities. Other times, you feel like you're in not a secret society, but like a club where you say things in the club that you might not say elsewhere. I'm a writer, I'm an analyst, I'm a public speaker, I'm an author, I'm a portfolio manager. I feel that I've got to, kind of call it like I see it, and it doesn't mean, I have a perfect analysis or perfect track record, but it does mean I'm working hard and trying to convey to people exactly what I see. But I'm not a government official. I'm not the head of the IMF. I'm not on the board of governors. I'm not a Reserve Bank president. So I don't have some of those responsibilities to avoid panicking people. What I'm trying to do is warn people about some of the threats out there. And we talk about gold and money, but there are cyber threats, there's financial warfare, there are economic sanctions, there are other things. There are situations where a natural disaster, say, what does a natural disaster have to do with money? Well, apart from the cost of repair, but if you look at what happened in Fukushima, Japan in March 2011, what happened was an earthquake at the bottom of the ocean, massive seismic disturbance, that then caused a tidal wave, that then crashed into a nuclear reactor, that then caused a meltdown and release of radiation, that caused a panic on the Tokyo Stock Exchange. So here you went from an undersea earthquake to a collapse of Tokyo stock prices. So it does show how complexity interacts, how contagion spreads, not just across financial channels, which it absolutely does, but from natural disasters to man-made nuclear reactors to stock markets. That's the world we live in. There are a lot of dangers. I've never said be 100% in gold. When gold goes down, people beat me up. They say, "Oh, Jim, you're an idiot because you said." I never said 100%. I said 10%. I still say 10%. To me, that's the right amount. If you have 10% of your investable assets in gold, and it goes down 20%, it's only a 2% portfolio loss. Because if you have a 20% decline on 10% of your portfolio and everything else is even, your portfolio has only lost 2%. But if I'm right and gold goes up by multiples, that could be your insurance against losses and everything else melting down. So to me, if you don't have gold in your portfolio, it's like not having fire insurance on your house. You better hope your house doesn't burn down. And to go, one other thing I just want to follow up on. I have my book, The Death of Money, but you're in it. I know that readers who have read the book are familiar with that, but for some of our viewers who might not have read the book, you did a fascinating Q&A with Mario Draghi not that long ago at Harvard University, and I commend you for asking a tough question of the head of the European Central Bank, but his answer was even more fascinating. I'll just read parts of it quickly. This is a quote from Mario Draghi answering a question from Takoa da Silva, but he says to you, you're asking about gold to someone who has been the governor of the Bank of Italy. Bank of Italy is the 4th largest owner of gold reserves in the world. I never thought it wise to sell gold because for central banks, this is a reserve of safety. It is viewed by the country as such. In other words, here's Mario Draghi, the second most powerful central banker in the world after Janet Yellen, speaking to you, saying that gold is a reserve of safety. You don't hear central bankers speaking that way very often, but I commend you for getting that quote, and I was glad I was able to use it in my book as part of a longer explanation of the role of gold in the international monetary system.
Well, Jim, I was also honored by your having added that in there, and it was a pretty exciting experience, and very grateful to have had that opportunity, and then of course now to be sitting down with you discussing it. Thank you very much. Well,
thank you. You've spoken to Mario Draghi. I've spoken to Ben Bernanke. So hopefully the viewers will get a lot out of this interview because we've had some firsthand interactions. Thank you.
In winding down, is there anything you think we may have missed?
No, I think there's pretty good conversation. I mean, what I would say, I know a lot of gold investors are very discouraged. I think we were explaining why, the low dollar price of gold is just the inverse of the strong dollar, but I would expect the dollar to get weaker. But I did have an interesting conversation with Jim Rogers not long ago. Of course, Jim's a famous commodities trader and stock investor, stock analyst, one of the best in the world, and he doesn't just deal or invest in gold. He invests in all commodities and looks at emerging markets. So he's been around longer than I have and knows more about commodities than anyone I know. But he made a very interesting observation. He said, nothing goes from here to here without a 50% retracement somewhere along the way. So if you pick your base, it could be $200 an ounce or whatever you want, and I see gold going to $5,000, $7,000, $10,000 an ounce, and to me that's not a stretch. If you want to go back to a gold standard, or you have a global financial panic and you need to restore confidence and get back to gold, and you don't want to cause deflation, which you wouldn't, that's the price of gold. That's where gold has to be to avoid deflation in a world where you're using any kind of gold standard. So that's not a complicated equation. That's kind of 8th grade math, but you can do that. So, but let's say gold's going to go from 200 to 10,000 or higher. And what Jim says, it never goes there in a straight line. Somewhere along the way, it'll go down 50%. So if you look at the August 2011 $1,900 high, we're down about 50% from 1900. So the idea that we went from 200 to 1900, back down to close to 1,000, Jim would say that's the way of the world. That's the way commodities behave. But he told me, he said, I'm not selling the gold I have. I'll buy more at around the $1,000 level. And my expectation it would go much, much higher from there. So no reason to be discouraged. It's a long game, and I'm personally buying gold, and I recommend it to investors.
Jim, as a last question, final question, for the person watching, how can they participate? How can they follow you and receive any of your regular communications as you go forward?
Thank you. I have a couple channels. My Twitter feed is very active. It's at James G. Rickards, Rickards. So he's my middle initial. So at James G. Rickards. You can follow me on Twitter. I have my books, The Death of Money and Currency Wars. I have 2 new books coming out next year, 2016. So I'll be saying more about that. But I also have a newsletter, Strategic Intelligence, Rickards Strategic Intelligence. Pretty easy to find online. I think it's good value. We have a monthly newsletter. The kind of travels and conversations I've mentioned are the things I put in the newsletter, so hopefully readers can enjoy that also.
Jim Rickards, author of Currency Wars and the Death of Money, thank you so much for sharing your comments with us.
Thanks to go.